It's Tuesday, the 16th of May 2015. Just a quick sound check. I'm sure everyone can see Nicola's screen now. Her desktop sharing is active. She'll be turning her mic on in a small moment. So I'll just do a quick introduction. I think everyone knows Nicola from social media. She's been on Twitter a very, very long time. Probably one of the founding, social media trading, trade idea sharing people. I've known her and been following her for a very, very long time. So this morning she's going to be giving us a presentation on her trading methodology and some live market analysis. We'll be getting some insights from her. She's a very experienced trader who's been on the scene for many, many years. She's been trading since 2006. A self-proclaimed market-aholic. She says she's married to the market, and I'm sure we have a lot to learn from her. So without further ado, I'll hand over and let's get her insights. Yeah, you're going to have to turn your mic on, Nicola. It's at the bottom of the screen, the microphone icon just under the chat box. There.
Hello.
Yeah, that's great. Your sound is coming through good now. Thanks.
Brilliant. Thanks. And thanks for being so patient while I sorted this out. This is the first time I've done anything like this. And since I'm going to do this, actually, I've changed jobs. Some of you might have known that I used to be working as an analyst at Futures Techs. And since the start of the month, I've moved and I'm working at a fund trading with a friend of mine in a two-man trading team. So I had to ask for some time off to do this morning. So, but I wanted to do it, so that's quite fun. Anyway, so now I'm trading 24 markets. 9 of them are stock indexes, 3 bond markets, I think 5 FX markets, and some metals and oil. So I have quite a broad view of the market now, which is quite interesting. The weird thing about it, though, is there's 2 of us in the trading team, and my job is mostly the analysis, and he gets to do all the clicking, the buying and the selling and the moving the stop, and so that's quite irritating. I know you're all individual traders, and you probably like to do it yourself. So suddenly being in a trading team where the other guy gets to do all that, and yeah, I'm getting used to it. So I think I'm going to start my look around today, looking at stock indexes which have rolled over. Back at the end of April, I thought we had probably put in a high in the DAX, and I'm going to show you why I thought that in the DAX, which is quite odd because I don't normally look at Elliott Wave, but in Elliott Wave, in impulsive moves, you normally see 3 waves. This is a monthly chart of the DAX, and I'm going to zoom in at the bit that I'm looking at. And the most common relationship between wave 1 and wave 3 is equal. So wave 5 is equal to wave 1. So you can see that this rally here, or this distance here from the 2008 low to the 2010 high, is equal to the rally that we've put in from last October's low to the high we made in April, so March, April. So that's why I thought that there was the potential for the DAX to top there, and and I had this level marked and a big line you can see. So that was quite interesting when, when you mark a level and you have it on your chart for ages and ages, and when the price gets there, you suddenly get a big reaction. It's usually a good sign that it's working. So I'm going to go back. I mostly use Fibonacci in my trading, and I'm going to go back to really simple things to how I look at trend, because I try to always trade with the trend. One of the first touchstones that I suppose I use in my Fibonacci trading is the 23.6 Fibonacci. So we're looking at a monthly chart of the DAX here, and you can see that the first test that we pulled back to in April was this 23.6 Fibonacci, which was around 11,500. And for me, when you break that, it pretty much is a sure thing that you're going to go to the 38.2 next. And it's quite key. I like to see a reaction of it off it. Although you can't see it clearly on a daily chart, we did get quite good reactions. And so what happened, and this is I put my Fibonacci on this last swing, on this what we call the last wave 5. So from the October low, I put the Fibonacci just on this swing rather than the whole swing, and we broke the 23.6, and then we rallied very sharply off the 38.2. So that's usually a really good clue that your fibs are working. Now that we've broken that 38.2 low, today, if we close below it, I think it's a pretty much sure thing that we're going to go to the 50 next, which would be at 10,390. So this is the futures prices. Obviously, you have to adjust that for the cash. But that's so today is quite an interesting day. It's going to be quite key whether we hold these levels that we've broken. The same in the FTSE as well, and the S&P. The oscillators are all down on. I use oscillators to time my entries, so they're all down on the lows. So that is quite interesting. The other thing I use quite a lot is a Fibonacci expansion tool. So I measure the relationship between the swings. So because there almost is, always is one. So I'm going to put this on here. This is the daily DAX again, and you can see that we've gone through 618, which would be a normal relationship. So the next level down here is at 10,678. So I would have that level marked, and then you can see that the 127 of this first swing lines up with the 50 and a whole bunch of other things, and so that's why I've got a little pink area on my chart here. And the 1.618 of the first swing lines up with the 618. The DAX, by the way, absolutely loves the 618 retracement. Like, it's one of those sort of fibs you can mark on your chart and it'll almost always turn there. So I'm just going to put this pink because I really do think that being the 1.618 and the 618 retracement of that last fifth wave is probably where we'll end up. And you can see that there's some sort of, we've got some good structural support there as well. So that's what I'm looking at in the DAX. I also, quite interestingly, and the very first method I learned when I learned to trade was moving averages. And I used to trade a moving average crossover, and then I would bracket lines around consolidation and trade the breakouts in line with the moving averages. I'm going to show you in a minute on an hourly chart what I mean by that. So you can see that we got the high in the DAX in March, and then we got the moving average crossover at the beginning of April. I use a 20 EMA and a 50 SMA. So for me, that's like a signal that we've rolled over. So the next rally back to those moving averages are sell signals. If I go down to a 4-hour chart, what I would probably do on this is I would mark, as the price rallied, I would put a trend line on these lows and then sell a break. And you can see that's another, again, break of the moving average consolidation. So that's pretty much actually my trading method. I use Fibonacci to identify levels, and then I use moving averages and trend lines to trigger me into trades. So if I go down to an hourly chart and I go back, I can show you how that would work. Oops. Sorry, I tried to move my CQG over to this laptop so that I could do this presentation, and it didn't like it at all. So and I wasted the whole morning losing the charts that I'd set up, which is a bit annoying. So here you can see, here's the top. You can draw a trend line under the lows as they consolidate, which I would have done. Then you can see you got the moving average crossover here, and then it triggered quite a nice spike. But if you wait and you instead trade the break of the trend line, which is the way I was taught with this method, you wouldn't have caught the spike, and what you would then have done is got short here. I like to draw trend lines with a very fat marker and then trade a really clear break of them, because you see so many false breakouts. And then if you're not sure, then trade the retest, which you almost always got. In fact, we got twice here. So an hourly moving average crossover. So if I've put a level, say, imagine, I haven't got it marked here because I don't been trading off these charts, but if that was my level, the first day that it came into it, I wouldn't sell the level. I would let it settle down for a couple of days and then wait for the moving averages to cross, and then that would be my trigger entry. So when a market makes a very spike low or a V bottom, I'm not usually, even if I've marked the level, I'm not usually the person that caught the low, but I will catch it when it confirms a reversal because of how I trade. So I think this is actually the first time I've ever told anybody my exact trading method. So the 30 or so of you in this room are quite lucky today. So mostly I clean up my charts actually when I post them. Sorry, I'm just going back. Just because people think moving averages are Mickey Mouse or old-fashioned or they don't work anymore, and they really do work. So anyway, so that's my view of the DAX. We have a really key level today. It's also the 38.2 Fibonacci. I'd like to see if you are at all interested in a bounce, we really do need to close above this today. And if we don't, we're going to go much lower. So I'm just going to move on to the S&P today because that's quite similar in levels, sort of important levels. In the S&P, you can see I have these levels marked, but the moving averages were still bullish. We hadn't crossed over. The sharp moves yesterday and today have actually got a moving average crossover now. So the next rally and consolidation in the S&P for me now is a sell signal, unless we can rally really sharply today and turn these back up again. But even then, it's not really a compelling buy because they're pointing the wrong way. I think if we perhaps drew a trend line through these highs, I would be interested. But I'm just going to switch to my IG charts and look at the SPX. And the reason for that is they have the cash index, and the other one I was looking at is then if I this is really messy, but if you put a Fibonacci retracement from the 2008 high to the 2009 low, we have just tagged the 1.618 extension of that move, which for me, if you're all Fibonacci traders, that's a really big deal. And if you draw this on the futures index, we haven't quite tagged it yet. So that's why quite often for big like monthly Fibonacci moves, I switch to the cash index. And if you're wondering, looking for an MT4, so if you're using MetaTrader, or see which index you've got, whether it's the futures or the cash, because it does make a difference. So also I have Fibonacci timing. If I take the 2000 high and the 2008 high, we get a turn point next month in the S&P. So that's also another reason why I'm looking for a reversal here. So that's my view of the S&P. But to confirm that, we really do this low. I need to see this low break, and that confirms then a lower high here. These really aren't clear lower highs yet, but if we see a lower high here, then obviously we can measure this first I'm going to put my Fibonacci expansion tool on. Then you can put this first swing on, and you can measure then, once you confirm it, where we're going to go. So an ABCD equal correction would take us to down here to 2050, which is also the 50. No, that's not. Which moving average is that? That's a 250 moving average. I've got the wrong ones on here. I'm really sorry. The charts I meant to set up aren't set up. But anyway, so for me, that's a, you know, the moving averages sort of say we've topped, we've got the level, we've got the price action. I'm just looking now for a lower low, because, you know, with these big Fibonacci levels, they can be really sticky. You can get another run at the highs. So that's what I'm basically on watch for. So that's the DAX and the S&P that we've looked at. In the S&P, I'm just going to show you how I trade. So entries, for example. So I'm just going to put this chart up. So I had a level here. You can see I've got like a grey hash line. It was this was support, and then back here it was resistance. So I had this level marked, also using Fibonacci, that I wanted to look to buy off, because at that time we still had bullish moving averages. So I'm just going to, here we came into the level. This was the 9th last week. I didn't buy it that day. On the 10th, we, in the morning, in the UK session, we got the moving average crossover. So what happens here is we break above, then we get some consolidation. I drew a little trend line here, and then I traded the break of that trend line, and my stop, instead of then having to be below this low, it's now below the moving average cross here. So I have a tighter stop, and I got I got actually 3R trade, because I went to the orange line, which was my resistance, which is where I exited the longs and waited for another setup. If you're going to do that in reverse, okay, this is how my trading setup works. So I have this orange line as my level. We make actually what is an inverse, a regular head and shoulders pattern here. And literally as the pattern breaks, you get the moving average cross. So this inside bar actually was my short entry. And because I'm a bit of a chicken and the Greek news was too scary, I closed my position for the weekend, and I haven't put in a position in the S&P since. So, but we're looking, like I'm looking for this level to hold. We've obviously tripped the stops below yesterday's low this morning, but the really important level is last week's low in the S&P. So that's my view of the S&P. All the other indexes say this is going to go lower. But we'll see. A good rally today would negate that crossover and turn everything up again. I'm just not sure that sentiment is bad enough to do it. You know, you need everybody to be really gloomy and for a good proper low to be in, and I'm not sure that everyone is. It seems like everyone's sitting on the sidelines and just waiting for the next sort of Greek bomb, doesn't it? So that's really my quick run around the indexes. I can look at FX, I can look at oil, I can look at metals or gold. Does anyone have anything you want to look at? I have to say that I think FX is really unexcited at the moment. I think probably we should look at the euro dollar, because oil is the most correlated with the euro dollar, and because it's the biggest component of the dollar index, and everything sort of moves around it. And you've noticed, you know, because the euro dollar has gone sideways really since, well, the start of the year. Everything else has gone sideways too. I think gold is like almost at the year open price. So, okay, so here's the euro dollar. I'm going to go to a monthly chart because I like monthly fibs, and I think we're setting up a harmonic pattern here. There is the potential where we have reversed, although we massively overshot the level I was looking at. This is the 618 and also the 127 of this big rally in the middle here of the 2010 rally. So there was some Fibonacci confluence here. I was looking at this for a bounce. I'm not sure yet that the bounce is over. It's also the 1618 of this most recent rally here, and as you know, that for me, the 1618 extension of the most recent rally, I'm just going to zoom in so you can see what I mean by that. And I'm just going to put this in a brighter color so you can, there. Okay, so this is the most recent rally in Eurodollar, and when we broke the low, I put a Fibonacci retracement on it, and then I'm looking for support and resistance at the 127, which we broke and was then resistance, and then the 1618. It was a bit of a messy save, but quite often when you see that, it does mean that we'll go back at least towards the previous low. So that's why this was a sort of a confluence zone. I'm just going to clean that up to make this chart tidy. Okay, so what I expected to see at this level was a two-wave correction. When you don't see a two-wave correction, what you quite often see is consolidation sideways, and it usually makes a pattern like a wedge. So my view of the Eurodollar, and I've now switched to a weekly chart, is that we're either going to fail at this high and we're going to make a wedge pattern and continue lower, or we're going to make two swings higher from here. We're going to break out here and continue to 118, which is the fib level, and which is also this, if I zoom out a bit, previous low from 2010. So it lines up all with that. So I think that if this consolidation breaks long, that we'll go to 118, and then that likes a very interesting level to sell against, or we roll over. But the Greek news is so gloomy, and we haven't sold off on it. Like, there's massive trading in FX options in Eurodollar. So I think people are putting their bearish bets in the options. The 1 month implied volatility in FX in Eurodollar is the highest since like 2011. So people are obviously expecting some stuff, but the moving averages are all bullish. We're well above the big FOMC spike highs from February and March. So it's really kind of hard to be bearish this right here. In fact, it's really hard to be anything. We're looking at a daily chart now. We're just going sideways. But it's quite clear on these bad news headlines that we're really not selling off very much. And I think that any kind of a deal that is done for Greece that is not an exit will cause a massive rally. And I think even if we get a Greek exit, will cause a massive rally. And I think even if we get a Greek exit, it seems like failed just shy of the 2008 highs. There was a lot of, you can see this, we had this, 2-month consolidation wedge pattern that finally broke. We've moved lower. We've come back and tested the underside of that. Although, we do look quite supported and we've got moving average support. If you take a broader weekly view, this does to me look lower. And because we rallied in 5 waves, so 3 waves higher, I think at the minimum we're going to see a two-wave lower correction here. So I am putting on Fibonacci expansion, looking at this first leg, and I'm going to put this in bright red so you can see. This is how I look at this. I'm sure you're all shocked at how Mickey Mouse my charts and trading are, aren't you, listening to this? Probably are. Anyway, so we can see that if the second leg of this correction lower is only to the 618 of the first leg, it'll make a slightly higher low. So that would be our wedge pattern up here setting up. So it would probably see something like this. And if we make a new low, we're going to go down here to around the 116 level. And if we go to the 1.618, we're going to go down to 111. So that's basically how I mark my charts for that. So I'm just going to leave them on, and I'm going to clean up all these other ones. And see, this is how I also look for levels. So although in the dollar CAD we have a strong uptrend, I think we can say that we've most likely topped, and we're looking for a second leg lower or sideways consolidation and a pattern that we can trade. That's what I'm looking at there. So if I put my red Fibonacci on from the lows, you can see that we've also stalled at the 23.6 Fibonacci, which is the first thing I look at for trend. So as long as we're holding above the 23.6, we are still trending higher. So we could, if we make that wedge, we'll hold the 23.6. If we don't, then we'll continue lower to the 38.2 next, and the 50, which lines up with the 1.618. So I look for confluence where they line up together. So I'd probably put in a rectangle here, leave this on my chart, and then once I clean up through, I'll leave that marker on, and so you can see that if we continue lower in dollar Canadian, we're likely to go to 111.20, and that's how I mark that. So I'm just going to go to a lower time frame because I've shown you my broader view. So now I'm going to show you on the daily, this looks still bullish. If you can see, the moving averages that I look at are still holding up a bit, but this price action, when it sideways inside itself, looks like a bear flag. So I would draw a line under this. This is a daily chart, and a break of that lower signals that the next move, I think, is underway. I haven't drawn that very well. I'll tidy this up. So when you see like sharp moves like this, sharp sell-off, long candles, that looks impulsive. And then if the recovery is very shallow, choppy, sideways, you can say that that's normally corrective. So you really want to be going in the direction of the sharp, long moves because they're going to work better. So on a 4-hour, we've got sell in our moving average. On the hourly, we're still sideways. So basically, this is now like a wedge pattern. So on our hourly chart, so now you just put this on and really don't diddle in the middle of these patterns because you will just get chopped around. Trade the breaks or trade against them to stay within the pattern, but in the middle of them, it's just a pretty much no-go zone for me. So that's the dollar Canadian. I'm just going to see if there's any questions. And is there anything anybody would like to look at? Catherine. Catherine, yes, I'm going back to the FTSE next. And Steve, my best friend is the 20 EMA exponential moving average and the 50 SMA. And those are the ones I look at. But lots of, everybody else I know that uses moving averages uses different ones to me. I know someone that absolutely swears by the 14 EMA in the DAX. So really you have to, I think if you're trading one market, put different ones on and see how they work and see how the market reacts to them, because you really want the one that kind of works on the market you're using. So I'd say play around. Fundamentals. I use to really avoid getting stuck in something. So like the last thing you want to do is put a really good trade on that looks like a great setup and get blown up by you know, fundamental news or something like that. So I use it to, I suppose, to avoid getting blown up in stuff, but I don't really trade fundamentals, just because market positioning it can already be priced in, or you're hearing it late, or um, it doesn't always, I use it, I suppose, most to avoid trouble and let other people analyze it. I am fascinated by market fundamentals, and I read about it all the time and post articles on Twitter, but mostly that's because I'm interested in the market and I'm passing the time in between trade setups. Like, for me, Twitter's great, really entertaining. I don't know, I can't actually remember what it was like trading without it. We had funny AOL chat rooms and stuff. But yeah, when I found Twitter, and I suppose, one of the first, but um, yeah, it was great. It's like, I suppose Twitter's like a trading floor, when everybody's shouting about something and roaring about something, you get it's the best indicator of sentiment and what's going on and what everyone's feeling. So that's what I really like Twitter. You can get a really good sense of when everyone's too bearish or when everyone's too bullish as well. So I think it's really quite useful for that. So that's why I like Twitter so much. Okay, so here is I'm going to go to the cash FTSE actually, because once again, the futures don't really have the big levels. Okay, so here's a monthly chart of the FTSE, and I've been bearish the FTSE for a while, and I did post this because from the 2002 low, we've made a perfect AB equals CD at 69.50. So that means two equal legs from the 2002 low. And that lines up perfectly with the 1999 high. So when you see that, that's like a lot of confluence around that 69.50 level. We did overshoot it, but the fact that we got there and then got the reactions that we did, only once did we get a monthly close above it, and that was last month in a little sort of monthly doji, not quite a hanging man, but certainly not inspiring to buy it. So I've had that level marked for quite some time. What's worrying about that ABC is it has the potential to retrace sort of a considerable amount of this entire pattern. So 78.6, I would say normally, which would be awful. That's, back to 4,100. Let's hope that doesn't happen. But so how would we know, and what would we put on? Well, for me, from this swing, I would put on the big Fibonacci, and then the 23.6, which is at 62.61 in the cash, is for me key for the trend for this swing. So if this isn't an ABCD and we are going to continue higher, we will hold above 62.61. If we fail at 62.61, then we'll go to the 38 next, which is 57.26. So I'm just going to take the expansion tool off, so because I don't want that 618 confusing. So that's my view of the FTSE at the moment. We have rolled over on the daily moving averages. If I go back, you can have a look and see the daily moving averages rolled over at the start of the month. We're getting quite an impressive reaction. So really, I don't see any way. I think we sell rallies all the way back down to here. There are some obviously pretty good levels of support in between here and then. The 66, 69 level from the end of March is pretty key support because it lines up with the December high. I haven't got it on here, but if I put on the futures, the 200-day moving average is also at 66.60. We're sort of bouncing off it today, but otherwise, I think they're just going to be bounces. We are going to continue lower because we've done all those good things like a lower high and lower low, and we're rolling over. And if you sort of look at the Elliott wave of this, we've got wave 1 here up. We've made 101, so really we've got, I think we could be starting that famous third 3 of 3 that they all talk about in Elliott wave, which means quite a violent wave lower. So I think if we do see quite a violent wave lower, the best thing to do is, if you're an investor and you're buying stocks, is to sit on the sidelines and wait and see what happens at 62.60. June is the second worst performing month of the year, so it's not a big surprise that we're selling off here, and the better the correction, the better the opportunity to buy. So that's my view of the FTSE. So if I go to, I'm just going to go down to a 4-hour chart. There is potential for us to find support. We are very oversold. There is potential for us to find support on that 200-day moving average, but that's, yeah, it's looking pretty bleak. I'm just switching to this is futures, I think, but we're still in. So God, I wish I had my CQT charts here. So yeah, no, I don't see much support in the. If I was trading this short term, okay, I'm going to look at the last swing. The last swing was last week's rally. If I put my Fibonacci tool on, I'm looking for, remember, if the 127 fails, I'm looking for the 1.618. So the 1.618 of last week's rally, which was our next support, is down here at 66.35. So yesterday's low is now resistance, and 66.35 is support. So that's my view of the FTSE. 67.45, which I haven't got marked on this chart, and I should have. I'm just going to put it down. Was the really big level that I wanted to hold. So that big level, the reason I wanted to see that hold is because it's not on here. Yeah, here it is. That's the 2008 highs, and we're now back through those. So I really did kind of want to see these hold as support, and they haven't. So that was the level that held last week, and we're now 2 days below it. So that's resistance on any rallies now. So it's really interesting, when you put a Fibonacci on. I'm just going to line up, zoom in a bit. So I've put this retracement tool on this swing, and I've put extra ones. I do customize them, and I've put extra ones on. So I'm looking for the 1.618 and the 2.618. And if you can see, go all the way down, and the 423.6 lines up with this 23.6. And whenever you do that, and they all line up together in a location or a price, and you get a cluster, that kind of confirms it and makes it a really big level for me. So the fact that that also projects we're going down here, and then I wonder if I put one on here as well, does that line up? No, it doesn't. No. We'll see if this lines up with any of. Anyway, so this is kind of how I fall around. So there's an 88.6. So yeah, that's how I do. Like, we need to get a bit closer and have put a few more bounces in, and then you can project. But that's what I look at. But when you're trading like this, the most for me, the most important swing is the most recent one. So the most recent one is last week's rally. That's the one that I'm looking at and projecting from, and so that's the one that I get the support from. So 66.35 is the support that I'm looking for in the FTSE next. So let's see if there's any more questions. Silver. Oh, I haven't looked at silver for ages because I don't have limits to trade it, but I do have limits to trade gold. Here we go, silver. Here we go. Love to look at silver. I'm just going to clean up all this old stuff so it doesn't colour my view. Right. So I always start top down, monthly chart. Try and look at the bigger view, and I hope you can see this okay. I'm going to try and zoom in a bit more. So this was a harmonic pattern that failed here, so I'm going to take this triangle off. They don't always work. And I'm just going to change the template so that I can have some moving averages on here. No, hold on. Here we go. So monthly downtrend, say the moving averages. Here we go. So monthly downtrend, say the moving averages. The weekly, say the same. Still pushing lower and resistance at my 20 EMA here, and a wedge pattern which like we are literally clinging on to by the skin of our teeth. So it's an equal triangle. People say that they almost always go with a trend, which would mean lower. I disagree. I see them break either way, and quite often with a trend, you know, when you see a triangle pattern like this, what you're supposed to be able to do, I'm just going to go up to weekly chart to show you a bit better. What you're supposed to be able to do is measure the widest part of the swing. So the widest part of the swing would be from here to that high, and you project that from the breakout point, and that gives you the pattern target. Okay, but what I quite often see when wedges break with the trend is they fail. In other words, they don't go all the way to the target. So that would give us a target down here of $12 if this wedge breaks lower. But what I quite often see is they false break, and so to confirm it, it really needs to break this 2014 low to continue lower for me. The price action sort of says there are, we had a tiny little weekly doji last week, so it says that the buyers are trying. Gold is hanging on pretty well as well. It's hanging around that year open price, which is at 1180. So I think the price right now is 1181, which means for the entire year gold's gone nowhere, and silver is pretty much the same. Yeah, here's our year open price here, 1275, and we're at 16. So oh no, we're actually up on the year in silver, which is a bit more promising. So I'm watching this quite clearly, a false break lower here, followed by a rally back into the triangle, because we have broken it, is very bullish. So when you see a pattern and you get a false break one way followed by a reversal, you often get a very sharp move because it's tricked people the wrong way. So a rally here would be very bullish, very bullish. We'd come right out the other side. You then expect, whereas normally in a pattern, when you then touch the other side, you would trade it to stay within the pattern. When you've got a false break the other way, you expect it to break. And so if we did that, then we could project the distance you're going to travel from the breakout point here, and that would put us back to these recent highs. So that would be very nice trade either way. But that's my view on silver. Moving averages and trend says lower. Very important support and resistance here. So that's the daily. On an hourly chart, let's take a look. Yeah, like it's sideways. It does look like it's trying to make an inverse head and shoulders. When you see an inverse head and shoulders though, you really want to see, for the best patterns, you want to see symmetry. So you can see that this is a really complex left shoulder here with 1, 2, 3 dips, and we've only got, so if this is a head, and you do quite often see double or triple heads, don't be freaked out by that, because on a weekly chart that doesn't look like a triple head. But for balance, this would sort of suggest that we've got another at least week of sideways before this is resolved. If we were going to do the same as the left shoulder, we would probably then go, we'll do this, and then we'll do this, and then we'll do that, and then if that is a head and shoulders pattern, then we've got some symmetry, and then we can put our neckline in here, about there. And then, yeah, so then I would say if we get above sort of 1630, we're going to rock and roll all the way to 21. So that would be very cool, wouldn't it? So that's my view of silver. That's an hourly chart. I think we've got a little bit more of sideways to come. So having said I don't use fundamentals, I don't think we can ignore the possibility that we're going to get a rate hike from the Fed in June, which would be very interesting. So yeah, watch this trend line, possibly an inverse head and shoulders would be very nice. I'm just going to put in one more thing that let's look at Fibonacci expansion. So we're going to see what's also interesting about this in silver is this is an AB equals CD, so it's made 2 equal waves lower. So from the May high here to the end of May low, and then this decline at equal, where it says 100, which is bullish. So that, as I said to you, when you see an A, B, C, D, it normally retraces at least 78%. So that would take us to 1733 from this pattern, at least. So that's very interesting that it's also holding that. So yeah, this does have the potential to go higher. You're only wrong if you break, I think if we break the 11th of June lows, and then that's a proper break of the wedge now. Doesn't look very ugly today. I've noticed this in copper and gold as well. Every day that you'll get a really good rally like we had yesterday, and it gets everybody excited. And so you have a really good rally like this, and you measure, you put a fib on, and you say, what's the 50% retracement of this? And that's, here, 1605, going to buy it there. And the next day it will come back and go absolutely crater through that support. So there's never ever any trend or follow through in the euro, in the dollar, in the metals. It's done it this week in oil. Every time you think that there's a glimmer of hope that it's going to rally, it makes a big move, and then it just no follow through. It's very frustrating, but that's summer trading. So would anybody like to look at anything else or talk about anything else, or I'm happy to explain things. I don't mind. I hope it hasn't been too boring. I can talk about general trading if you like. Oil, Gary, do you trade WTI or Brent? Probably WTI, right? Let me see, I think I have that one. I think this is rolled over, hold on. Let me see if they've got August, because I'm really sorry about this. So on my big main computer that I trade on, I'm not allowed to use the internet. So I was trying to export all my charts over and just didn't get it done in time. But okay, that's no good. Let's see if they've got. So I'm using pretty rubbish charts. Gosh, yeah, I don't have a chart. And it's rolling over this week. But so I'm going to look at. So this is July futures, and you're probably in the August, because I know I've rolled to August, but I'm just going to look at, I'll show you in the July anyway. Okay, so much like the other ones, we've rolled over. If I put on my 23.6, if I take off these Fibonacci retracements, you can see, hold on, clean up, let's do some clean up here. Okay, so the red Fibonacci that you can see comes in, the 23.6 Fibonacci came in at 58.30 in the WTI. We found support off it the first time we tested it, which was mid-May, and bounced, but there was no follow through higher, and then we broke below it. And since then we've been consolidating in a wedge pattern because we have broken the 23.6 once. I do think that we have the potential to go lower from here to at least 55.70. Oil, and I've been trading oil for a very long time, for a couple of years. A few years ago, in fact, I only traded oil, so I can tell you that WTI loves the 38.2 Fibonacci and the 78.6. So this 38.2 fib at 55, mid 55s is really important. And if it fails, I would say that there's the potential to go a long, long way lower. If I put on a Fibonacci expansion, which I've already got on, but I'm going to take off and do it again so you can see that that's also where the ABCD lines up. So here we are in dark red. Okay, so you can see that you can see that 38.2 fib is also the ABCD. So 55.70. So that's what I'm looking for. I think if this wedge breaks lower, that it will likely fail. We won't go all the way, and that we could probably stall here if it's staying bullish. If we don't, then it's not bullish, and we'll see a much deeper correction. So I'm just going to take that off. So if we get one way to there, I think it's very likely we'll bounce there, and then we come back and we make another leg lower. Then obviously these highs and the 53, 54 area are going to attract. But for me, I'd really like to see this. I'm going to put, if we look at this in inverse, so I've just showed you where I think we've got support. So I'm a buyer, massive buyer at those mid 55s. But if I put my fib on for the entire decline from 2014 highs and take this off because I want to clean it up, you can see that we cleared and are now supported by the 23.6 from this decline. And the fact that we've reacted off it, like that very first test of it, we sold off against it, says that the market is looking at it to me. And that's important. So I think from here, because we're supported by this fib, that at the very least we're going to rally to the 38.2, which is at 68. So my view of WTI is I'm a buyer at 55s and I'm a seller at 68. And right now we're doing some pretty nasty wedge consolidation. If you're trading Eurodollar, what's very interesting is that every move that Eurodollar, trading Eurodollar, what's very interesting is that every move that Eurodollar has made, the WTI oil went first. So, and that works down on an hourly. You know, when you're coming in the morning, even if you don't trade oil, take a look at it because it has been moving the dollar, and so it's one to watch for sure. I hope that helps. Hi, Alex, Kiwi. I never trade the Kiwi, but I'm happy to have a look because I haven't looked for ages. So, have I got it here? Da, da, da. Hope so. That's fine. We'll open a chart just for you. Hold on. Okay, so the kiwi, the kiwi properly rolled over. For me, there are people that'll tell you that a double top has to be, within 2 pips of whatever. The kiwi wasn't, but this is a proper double top. And this is the swing low in between the double top, which lines up with this high here. So you know the rules of double tops. We broke the double top. You measure the distance from there to there, and then you project it from the breakdown point, and then that becomes your target. So our target in the kiwi for this pattern is 58. And when will we get there? Well, probably if you draw this trend line thing. So about there. So I know this looks really simple, but trust me, it works. So I'm going to put a little rectangle in. So yeah, that's my, so I'm bearish of the kiwi. How do I trade that? How would I trade that? Well, like I say, every time I trade moving averages crossings and I trade breaks of consolidation. So for me, I would have put a trend line support here, and I probably would have done one like that. So I'd probably fixed it here, and then I wouldn't have sold that because I didn't get the break. But once we got the break, we came out and we tested that breakout point, and that's actually quite a good lesson. When if you don't trade the breaks of these trend lines, people look for them to come back and retest the trend lines. They don't very often, so that would be up here. Very often, if you just mark the price that we broke the trend line, which is there, that's what the market comes back and tests, that breakout price. Why does it test there exactly? Well, because what happens is people will trade the break of that trend line, and then the market will go so far, so they'll get like 1R on side or something, and then they'll move their stops to break even. So the market comes back and takes all their stops and then carries on. That's how it works. And when I was first learning to trade, that used to happen to me all the time. I'd put on what I thought was a really great trade with a really great entry, and I was always trying to swing trade. And then I would move, it would go a certain way in my favor, and I'd move my stop to break even. And it's absolutely killer because the market just knew where I'd entered and it would come back and get you. So what I started to do was take partial profits. So, and I blogged about it for ages. I'd take half off. I actually would take a third off there if I was swinging that. And then that paid for my stop, and I could leave my stop here above the highs where it should be. And so that's what I did because it worked for me, because it was just so frustrating. I would get really good positions on, the market would come back, collect my stop, and then carry on. So that's what I tend to do. I will, when I enter a trade, I'll go in full size, and then as it moves in my favor, I'll take a bit off and then try and run it, because that's how I like to do it. So that's the daily kiwi. So let's have a look and see if you're not in where you might get some support. So for me, as you know, I put the fib on that swing. You can see that last week, the 127 of that swing is where we found support. We had a really good rally, came back and tested that low. So I think that that's done now, and we're going to continue to the 1.618. So for me, the resistance in the kiwi is at 70.19 and last week's low, and the next support is at 68.23. So I would sell against that level at whatever I said it was. Gosh, losing my marbles. Yeah, I would be a seller against 70.20, and I would be a buyer at 68.23, and that's my view of the kiwi. Very simple. I hope that helps. Alex, I use a 20 EMA and I use a 50 SMA. And if I go to an hourly chart, so that's oils, hold on. Let's go to the kiwi and look at an hourly. So this 20 EMA is my best friend. So when I'm entering a trade, I try and enter as close to the 20 EMA as I can. And if it's too far away, that would keep me out of the trade. That's like a limiter. I would wait for the moving average to catch up. So we're now in the Kiwi consolidating sideways. For the reasons I told you, I think that we'll continue lower, but you can't rule out a retest higher first. So I think I said 70.19, didn't I, last week's low? So yeah, so if this breaks higher, I'm not sure how far it will go, but because of the Fibonacci rules I use, the 23.6, you can see here. So if I put this here once again, I hope you can see this. So the 23.6 Fibonacci, which was at 70.09, was exactly the high that kept it. So that's what I use to remember keep me with the trend. So if you're ever sure, is this, are we just consolidating sideways before we continue lower, or is this a reversal and you don't want to use the moving average, you just want to use Fibonacci, then the 23.6 is a really good guide. I can recommend it. So I don't trade gaps. As in I don't do a specific gap trade because I'm a swing trader, but I do see gaps as important support and resistance on a chart. So I would use them as a resistance level. And I think that, if I'm watching a market and we've made a big gap lower, say, and I'm waiting for it to rally, then the bottom of that gap is resistance. And then once we break into the gap, then you can normally assume that we're going to fill the entire gap. So that's how I see gaps, but I don't do a specific gap trade. Does anybody else have any other questions? The guy I trade with is frantically trying.
Okay, that's awesome.
Okay.
Yeah, I think we're almost, in fact, we probably are at the end of our time. We've kept going for just past an hour. So I just want to thank you, Nicola, for attending and doing your presentation this morning. It has been fascinating, and clearly, even after all these years, you're still very, very passionate about charting and technical analysis and working out where the market's going. You can kind of get that sense of excitement in your voice almost. So I want to thank everyone for attending this morning, also and taking the time out to do that. And so we'll see you all at the next one. Thanks again, Nicola.